Welcome back to the channel. My name is Brad, and today we're going to go over what's in my portfolio. And this is my portfolio. This is not financial advice. This is not legal advice. This is not tax advice. This is my portfolio. My portfolio is 100% in tax-deferred accounts. Because the first comment is going to be, oh, that's not very good with leverage. Literally, that will be the first question. Well, probably not. But there'll be 5 or 6 leverage questions. And I'm going to say, Brad personally does not need to use leverage to retire. I worked for a living. And I'm now reaping those rewards of having money and to be able to retire. And I'm sharing my adventure with you. So, end of my soapbox. Let's get to it. Why do I do what I do? Sequence of returns. Somebody just asked today, well, if you're after total returns, why don't you just own the underlying? Ma'am, sir, it's called sequence of returns. Link below, full article. And let's go over this. So there's been multiple bears and multiple bull cycles. During these cycles, you can see market goes up, market goes down. And this is going to be based off of taking 5%. I'm taking 8%. And what you'll notice very distinctly, if you take 5% at the wrong time, well, guess what? Your retirement doesn't look too good 15 years from now. So let's go through these numbers. If you take $100,000 and you're going to take 5% and you take it at the right time, which is Mr. Blue Guy, hey, you got $105,000 at the end. Your retirement's pretty good, and the average return is only 4%. Okay, a little low, but sure. The green guy, same 5%, but hey, the market goes down at the beginning and not at the end, just almost reverse from the blue guy. He's got $35,000 in 15 years. His retirement is not going very well at all. On a graph, how does this look? It looks like the green guy is going to have to go get a JOB. Brad doesn't want a JOB. He's going to make some YouTube videos and yeah, he gets a couple dollars here. It's pennies. I'm having fun. This is my retirement. If it becomes unfun, I just won't do it anymore because I don't necessarily need to do it, but I like doing it. But that's just me. So just don't make me not like doing it because then I go find something else to do with my spare time. And I have lots of spare time, actually. Actually, working on the book. Worked on that book this week. Sequence of returns will be in the book of why you just can't buy the S&P 500. If you're newer to the market and you're only been around for the last 4 or 5 years or since 2000, which, you know, like my daughter falls into that, they don't understand this. This is what are you talking about? I could just put money in and it lasts forever. It doesn't work that way. Tomorrow's episode will be on NEOs, and I'm going to show you historically over 10 years on NEOs. Wait a second, NEOs is a new fund. What do you mean 10 years? 10 years worth of data. Brad came across 10 years with data, how NEOs has affected over 10 years. So you can see the pandemic and how it reacts. This is why I invest the way I invest. So, what's in my wallet? Well, what's in my wallet right now? These are not including in my living holdings. I got NVIDIA. I bought MSTU. I sold it today. I kind of told everybody my target was 180 and I was getting out. And you were like, why did you do that? And now I'm back into Misty. That's because Brad made almost 80-90% on his money, where Misty made 30. Okay, I gamed the system a little bit. I went back into Misty, but I made a lot of money because I used 2x leverage for a short period of time, and I just gained the system. That's all I did. I hold IBV, so it's uncapped. That's the S&P 500. QQQM, because I want uncapped money. And I have Berkshire Hathaway. Still, because somebody told me one time, you can invest like Warren Buffett. Well, yes, technically I can. And I have. Now, I've looked at some other funds, but all honesty, these funds do me just fine. So I have a large holdings of cover calls. SPY-I, QQQI, IWMI, SPY-T, which is now a smaller portfolio, GIAX, which is now smaller in my portfolio, FEPI, AIPI, T-SPY. And I went with T-SPY over XDTE because of how the NAV actually works against the SPY. And you can go look at it. Nothing wrong whatsoever with XDTE or iSpy. Both of them, great funds. And another one is, what fund on this chart doesn't hold the underlying? None. They all hold the underlying, and that's the way that I went with it. And this is my portfolio in my personal finances. This is the way that I see the world. You may see the world differently, and that's fine. And by the way, you're not going to convince me of seeing the world differently unless you can provide me a chart and graph, and you can email it to me. Saying down below that doesn't work, okay, like and move on, because I just don't have the time to figure you guys out. I bought GPIX and I bought GPIQ, and this is my total cover call, and that's GPIX and GPIQ came from SPY-T and GIAX. The same thing with T-SPY. I just moved money around just to fund those funds. Why did I do this? Well, Brad made a video not that long ago about the S&P 500 and what the top funds were. And GPIX was in second place compared to a 0 DTE fund. So Brad bought GPIX and Brad bought a 0 DTE fund. I think that's not rocket science. I think I've said on a couple videos, you should hold a 0 DTE fund. T-SPY, iSpy, or XDTE. You should hold one of them. I hold one that has the underlying, but the data clearly shows they do as good, if not better, and I'm going to say better than some of the other funds. And I'm only looking for total return minus my 8%. That's all I care about. That's all I care about. I am no longer in the game of let's see if I can beat the market. I want to be able to retire and sleep well at night. Holding GPIX, GPIQ, SPY-I, T-SPY in my cover call selection, I think I've done pretty well. And again, tomorrow I'm going to show NEOS with 10 years worth of history. And it all came from PUTW. There was something on their website and I scratched my head. It's kind of now on the NEOS website, and I found it and I'm like, wow, I can now look at what 10 years of history this fund would have done, and now I can sleep well at night because I can tell you what the historical looked like from 10 years, how this would have worked. So that includes the pandemic. Yes, there was a V-shaped recovery, but it also counts the 20% downturn, during 2022. So there's lots of downturns, lots of ups. So it's good data to look at over time to make a reasonable decision. Again, just a real quick chart. I did total returns, GPIX, total returns with a 0 DTE of iSpy. In third place was SPY, which gives me a bigger percentage. But okay, these are the funds that I chose because this is the way that I want to live my life. I think everybody should have some preferred stocks. It's one of my 5 pillars. I own PFFA. It's a preferred stock. I think it does well. It's done me well. It's up significantly this year, and it still pays me my percentage. I'm looking at other preferred stocks. I want to diversify a little bit of my portfolio, but okay, it's a great fund. Why get out of a great fund that goes to something else that might not be as great? It's a tough decision. I hold business development companies. So earlier this month, I put out a BIZD video on business development companies. I personally sold all my business development companies, and now I only hold 2 funds. Whole lot easier to sleep at night with 2 funds. They hold the business development companies for me, and I can sleep at night. I don't have any problems of just holding 2 funds that are diversified. I'm all about diversification, but these funds are diversified, and I'm good with that. I have sold all my master limited partnerships, and I've kind of funded my business development companies. I also funded some of my CLOs, so I really narrowed down my total portfolio to focus just on those 5 pillars. So the next one I'm going to say alternatives. I have SVOL. If you don't understand SVOL, that's fine. It does very well. It does have slight NAV erosion. Slight. Ever so slight. But total returns, it's up. I can pull my 8% consistently, and I'm just fine. And that is the stress that I try to put out. It is total returns minus 8%. You can speculate on everything else and you can try to beat the market. I don't have to anymore. I have an alternative, PTCI. Did a video on that. Yeah, I still have a Bitcoin miner. I turned it off for the video. This is really just Bitcoin mining for me. I believe in Bitcoin. I do speculate a little bit. It's a really, really small holding for me, but I'll take that return that they're giving me, keep on funding it. It's actually up over 20-some% since I bought it. I mean, who doesn't love something that's up 20% in your NAV and it's paying about 25%? I'll take that. Yes, BTC will go down. Yes, it's all over the place. But hey, BTCI actually holds some Bitcoin, about 25% of their holdings, in the exchange traded product HODL. All right, so HODL actually holds Bitcoin. So I kind of like it. Not that it's going to be 30% of my portfolio. It's less than 1. PDI, it's a high yield. So I bought this because Steven did an article on Seeking Alpha. They did some different things where they're bringing the NAV and the current price closer together. So you're going to see some price increase and it meets my 8% rule. RIV. So BCAT and ECAT that everybody seems to love. I bought some BCAT and then I started looking at RIV. Guess what? RIV holds BCAT and ECAT. So why do I have BCAT and ECAT when I have a fund with a fund manager that I'm paying that can manage it for me and negotiate all the closed-end fund deals? I don't need to. I'll just hold a fund, small holding, and it does what it needs to do. I don't have to invest in all these individual ETFs or closed-end funds and rush around going, what happened here? Why did this go here? Why did that go there? What are they doing? I mean, I literally every morning get up and there's a message. What happened? What happened? Don't care. I have a fund with a fund manager that handles that for me. Sometimes it's better just to hire the professional. So, real estate, another really small holding for me, RLTY, they hold other REITs and they manage that. It's again going into why pick my own REITs and not do a very good job at it, or pay somebody to do it for me so I can sleep at night. Utility companies and infrastructure, ASGI, UTF, UTG. Now, ASGI makes my 8% rule. The other two are close, but if I combine all three of them together, I'm good to go. Makes my 8% rule. Everybody should probably have some utilities because usually during downturns, utilities do well. Infrastructure normally does well. So hey, diversification. Again, small holdings, diversify it out, and live off of my 8%. That brings me to CLOs. I have EIC, and they don't do the equity tranche. They're a little bit higher. I have XFLT. They do senior secured loans. I did a video on that one. FSCO, another great fund. Now I get into some of the equity tranches. OXLC, ECC, CCIF. Do more of the equity tranche. A little more risky, 20% payers. And you just got to sit back and go, they drip. Some of these drip and have a drip program. And I put all the CLOs on drip just because I get an extra 5% off a price. Lastly, I've always put out recently that I do not buy into equities unless it breaks the 50-day moving average. It does not look like it's going to do that anytime soon. I'm getting closer to 5%. I think this month I'm going to be able to live off of 4%. So I want to have extra money sitting around. And where am I going to put that extra money? I'm going to buy a little more BTCI, just ever so slightly. And I'm going to build out CLOZ. Yes, that was recommended by a subscriber. I've looked at it, I've reviewed it, I've graphed it. It's a fairly safe fund, safer than equity tranches. We'll just throw that out. Way safer than equity tranches. So hey, I'm going with a safe fund that I don't need to speculate because I don't need that much more growth. I don't. I just don't. So why speculate to try to make ends meet? Because I don't need to. So that brings me down to the end. I'm still going to do some yield maxes. I still think you can build out a yield max better than YMAX or YMAG. I did a video on Seeking Alpha and kind of showed you how I built that out on momentum. And I think I'm going to do more of that and actually show you how that plays out over time, because in all reality, it is probably the better play. If you're into that, and if you were in retirement and that's what you want to do, go for it. Just be mindful of what you're getting into. And I'll just finish up with, I really appreciate you watching the video. Leave comments below. I have lots of funds to look at. Everybody's asking me about, I think right now, I think my total list is over 500 funds to look at. So, and I still have like 65 funds from Steven to look at. I will get to them eventually. I'm not going to hold another little bit of information. I think the max funds that I need is right between 35 and 45. If I start looking at beta and other factors, I don't think you get that much more diversification or movement in the stocks or the ETFs once you get past 45. You really don't. It really diminishes. You got diminishing returns, extreme diminishing of returns. So I think that's going to be right where I'm going to try to be at, 35-ish. Spread some of my covered calls out. I'm going to spread out some of my CLOs. I'm okay with my business development companies and my preferred stocks. I might spread that out a little bit, but I really got to find something that I really like, because that fund has really done me well, and I can't complain about it. Until next time, God bless.